Namaste. Good morning. Friends, for the mistake I did in the yesterday's class, because I went and verified that one question which we are not getting, I was breaking my head. I understood that I should have put it as 3.25, and I don't know, in the Glush I put it as 3.5. Okay, if you look at our classroom material, you will understand that it is suddenly I was unable to get the answers, and I was wondering what mistake I was doing. Then I understood that this is the mistake I was doing. Give me a minute, my dear friends. I Very silly mistake because of which I am changing some questions. 1 minute. So actually it is SBI rate plus 3.25, and I wrongly marked it as 3.5. I wrongly did it as 3.5, because of which only we didn't get answer for a particular question, and I was breaking. So I request you to go to question number 2. From there we are changing it. Okay. Please bear with me. It should be 3.25. It should be 3.25, and it should be 12.25. The answer should be 3797,500. 3797,500. Part 4 of the next question. You have written a theoretical answer. Anyhow, I am posting the day-to-day Excel. You can verify that also. Okay. So this is the aspect that went into me. Okay, so when I now go to that question which we left it as it is in the yesterday's class. Okay, if Focus Limited repatriated the excess money on 31/3/25, what will be the income that would be added to the assessment year if SBI rates 1 year marginal rate is 11.25, as on it's on the first day of the previous year only. It's on the first day of the previous year only. So we had an adjustment of 2 crore 50 lakhs, my dear friends. We had an adjustment of 2 crore 50 lakhs into 11.25 plus 3.25. So 14.50 percentage into, it should be worked on number of months, number of days. It should be worked on number of days. Okay, it should be worked on number of days. December, Jan, Feb, and March divided by 365. Okay, I am reworking it. This should be okay. Question number 5.3. Question number 5.3 of yesterday. Okay, question number 5.3 of yesterday. Okay, when I rework it, okay, I should not work it as okay. It is approximately December 31 days. Okay, December 31, Jan 31, Feb 28, March 31. So 121 by 365. 121 by 365. Okay, if I do it as 121 by 365, I am getting 1118 14.5. 11.25. Okay, 12017112 is the answer. Last night I was working this out. Okay, I was just trying to find out where I was doing the mistake. Then I referred the material that I did not do 3.25. I instead okay, please remember, I'm sorry for the mistake. 3.25 secondary rate, SBI rate plus 3 point, Libar plus 3. This is Libar. Okay, I thought Libar plus 3.25. This is 3.5, but that's my mistake. Okay, 3.25. Please correct it. 3.25. That is why this this question had a issue. That is why this question had an issue. Shall we move on? Shall we move on? Okay, to the today's aspects, my dear friends. Today's aspect, that is non-resident taxation. Non-resident taxation. A quick run through of the theory before going into practical aspects. A quick run through of the theory before going into practical aspects. Okay, shall we start? Now, with regard to non-resident taxation, there are various aspects from our examination perspective. Now I will speak. Not going into other aspects, from exclusively from our examination perspective. Okay. Remember the individual's residential status computation. It has two basic conditions and it has two additional conditions. Okay. This 182 plus 60 plus 365. Okay, 2 out of 10 years he should be a resident. Less than 730 days or more than 730 days he should be here. So kindly look for this condition. Okay, to know whether he is a resident. Okay, individual's residential status can definitely be, because in a question they can ask you how many days he is here, etc. So individual's residential status, you please remember it. You please remember it. And
Sir?
Yeah, friend.
Sir, I have a doubt in this. In the additional condition, there are two things: 2 out of 10 years and 730 days, sir. For 2 out of 10 years, na 2 completed years,
He should be a resident in 2 out of 10 years. Who is a resident? One who satisfies the basic condition.
Yes, sir. So if he is there for 240 days in 1 year and 182 days in another year, will that be satisfactory?
Two out of, yes, you said 2 out of 10 years is satisfied.
Okay, sir. So it must be like the 2 complete years.
No, I'm not going by 2 complete years. I'm just saying 2 years he should be a resident. How two
So it can
complete
be
years is
spread too.
365 plus 365. That's not what we are
Okay,
speaking.
okay, sir.
Okay, 2 out of 10 years, 730 days. Okay, friends, this basic condition B is not applicable for some categories of assessees. Indian citizen leaving for employment. Okay, member of a ship crew. Okay, member of a ship crew, Indian citizen or person of Indian origin visiting India. Visiting India, for them the basic condition 2 is not applicable. For them the basic, which means you will only test one of the basic condition. But then comes the concept of if the Indian income Indian income means received in India, accrued or arise from India, operated business or profession outside India but managed from India. These are known as Indian income. If the Indian income is not exceeds 15 lakhs, for these categories of assessees, it will be 120 plus 365. 120 plus 365 will be the second condition. So it might get applicable. It might get applicable. Okay, just a rough read through. Please give a rough read through of this. And we have then a question of Ravindra Jadeja. Okay, of that question, just have a look through. Ravindra Jadeja question, where he is a person of Indian origin. Okay, Chris Gale comes to India. For him, I will test the second basic condition. Ravindra Jadeja comes to India. I will not not Ravindra Jadeja, that New Zealand cricketer who recently scored also very well. Okay. Ravindra, okay. For him, if he is going to, you need not test the second condition. But if his Indian income exceeds 15 lakhs, you will second condition will be 120 plus 365. But anyhow, they are taxable at RNOR status only. So this is how we were looking at residential status of individual. That can be a part of it. But my whole focus goes to this residential status of companies. Okay, okay, I am again telling you, you have to be careful on this residential status of companies. Okay, my dear friends, companies registered in India. Okay, registered in India, definitely ROR. Companies registered, you need not work out where their poem is. It is registered under the Indian Companies Act. Be 100% sure they are a resident company, not even ROR, resident company. They are a resident company. Only for foreign company, I test something. Only for foreign company, I test something which is known as place of effective management. Place of effective management. It has two parts altogether. Okay, one on the basis of board of directors meeting. One on the basis of board of directors meeting. Majority of the board of directors meeting is held in India. Okay, majority of the board of directors meeting is held in India. Then they become a resident company. Majority of the board of directors meeting is held in India, then they become a resident company. Okay, board is not taking decisions, only CEO, CFO, CTO, like this, these people take the decision. And if they are in India also, it is the poem is satisfied. The poem is satisfied. The next is known as a aspect called active business outside India. Active business outside India. The next condition we test with regard to poem is active business outside India. When will I say a company's active business is outside India? 51% of passive income is outside India. 51% of passive income is outside India. Okay, my dear friends, passive income means both the transacting parties are AE plus all other income. Plus all other income. 51% of passive income is outside India means, okay, which means on the other end, if you want to go by the positive definition, because this is active business outside India, when will I consider active businesses in India means 51% of the passive income is in India. That means, okay, that is an Indian entity, even though incorporated outside India. Okay, so so first condition. Second, 51% of assets are outside India. Okay, in the book value of assets, if 51% is outside India, take the average. Okay, yeah, okay, 51% is outside India. Then with regard to employees, there are two conditions. With regard to employees, there are two conditions. 51% of number of employees. If 51% of number of employees is outside India, if 51% of number of employees is outside India, then active business is outside India. 51% of cost of employee, payroll cost outside India, then active business is in India. So when I redefine it, if 51% of passive income is in India, or 51% of asset is in India, or 51% of employees are in India, or 51% of employee cost is in India, then the poem is in India. Then the poem is in India. It becomes a resident entity. It becomes a resident. I mean, the poem is a. So I will tax it as if it is a resident entity. Am I clear to you? Am I clear to you? Remember this. In our material, there is a question called Sweden. Okay, Switzerland, Sweden, and Indian company, or India, Sri Lanka, one of the question. Just walk through that question. Just walk through that question. You will find the answers interesting. That is more than sufficient. That is more than sufficient. So, poem can be a questionable area. Poem can be a questionable area. Other than that, don't worry about residential status. Don't worry about residential status. Okay, now I am going to, okay, we
Sir,
are, so yeah, I am listening.
sir, in case of passive income, 51% is out of the total income or out of passive income, sir?
Out of the total income.
Okay, sir, thank you.
Yeah, passive income 100%, no, out of the total income. Yeah, that is, they will give you like this. Purchaser being, I purchased from a non-AE, sold to an AE. I purchased from an AE, sold to a non-AE. I purchased from AE and sold to a AE. Other income. So the last two, C and D, add it up. A, B, C, D is the total. C and D is passive income. So as a percentage compare.
Okay, sir.
Friends, moving forward. Now I am going to look into the next is what is about the scope of total income. After residential status comes scope of total income. In scope of total income, a very fast run through, but this is essential, at least for you to listen once. Salaries. If this is, we are only speaking about non-resident. For residents, these things are taxable. Only for non-resident. Salaries. If he has rendered services in India, then it is taxable in India. Okay, whoever pays, I don't mind. Similarly, so with regard to scope of total income, okay, with regard to scope of total income, when I look at salaries, okay, I look into, okay, services rendered outside India, okay, whoever pays, okay, not taxable. I'm only looking from the non-resident perspective. For a resident, global income is taxable. Wherever he earns, however he earns, it is taxable. Okay, so not taxable. Okay, services rendered in India. Okay, okay, my dear friends, taxable, taxable. There is one big exception here. Okay, Indian citizen working in embassy office or high commissioner office outside India, because their salary is payable by the government of India, it is taxable. It is taxable. Only the salary is taxable. Allowances and perquisites are not taxable. Allowances or perquisites are not taxable. Is the class clear? Okay, right. Very good. Okay, this is sufficient to understand. Okay, house property. Okay, if it is located in India, it is taxable. House property, if it is located in India, it becomes taxable. House property alone, if it is located in India, for a non-resident, it will become taxable. For a non-resident, it will become taxable. So, some interest student has sent me question. I thought it's your question. Okay. So, house property, if it is located in India, it becomes taxable. Is the class clear? Okay, right, fine. Now comes to the core areas like business or profession. When it will be considered, if it is in India, when it is deemed to accrue or arise in India, the word habitually is used by the law. The word habitually is used by the law. Habitually settles contract. Habitually does the role of entirely closure of contract from beginning to end of the contract. Habitually stores stock and delivers, not just not just liaison office, which just explains about the part aspect. Okay, Rolls Royce case. Okay, otherwise they should store and they should deliver the goods. Okay, in these cases it will become taxable in India. And then we add a concept called significant economic presence. Download of software and user interface. Okay, download of software 2 crores, user interface 3 lakhs plus users, you will feel that it is in India and it will become taxable in India. Okay, this is the cases of, okay, you should remember, mere purchase will not amount to, mere purchase and export will not amount to, and cinema films, if it is shot in India, it will not be considered that the business is in India. News article, you will not consider it as news agencies, you will not consider it as business in India. In other words, remember, habitually means repeatedly, performs the closure of contract, closes contract habitually, purchases, stores and sells. Mere display will not amount to business or profession, that is business presence in India or business connection in India. Only if these are performed, it is considered as. Okay, just remember, if the question says repeatedly or habitually, tax it. Otherwise, you can just, what is business connection? If it is a general question, which once they have asked, okay, you have to write this: habitually closes contract or does the role of closing the contract, habitually stores, significant economic presence is also business connection. significant. And in all these cases, you have to remember income attributable to the business connection is only taxable in India. It's not like ROR where global income gets taxable. No, no, no. It is only income attributable to India is taxable. Is taxable. Is the class clear? Okay. Now I am entering this next main zone of capital gains. Next main zone of capital gains. Asset in India, boss, no doubt about it. No doubt about it. It is taxable. Okay, I'm only talking about a non-resident. Asset outside India, boss, no doubt for a non-resident. If he is not receiving it in India, other things, it is not taxable. Asset being shares of a company which substantially derives its value from assets in India. My dear friends, shares of a foreign company sold outside India, India cannot tax it. But if it is of a company which substantially derives its value because of assets located in India, in that case, the capital gains gets taxable. In that case, the capital gains gets taxable. What is substantially derives its value? Exceeds 10 crores plus it is 51% of value. Substantially means the value also exceeds 10 crores and 51% of the value is from Indian assets. Then it is considered. Okay, then it is considered as you are taxable for the sale of assets in India. Okay, otherwise, my dear friends, if you are owning less than or equal to 5%, it will not be considered. It will, if you are owning, even in this company, if you are owning less than or equal to 5%, it will not be considered. On which date I will measure this substantial interest? On which date? Okay, last balance sheet date. Last balance sheet date. However, if on the date of transfer value exceeds by 15%, than balance sheet date, then, my dear friends, you have to consider this date, where the value exceeds 15% than balance sheet date, you have to consider this. Are you clear? Are you clear? They are questioning you on this. Not even business connection, but on capital gains, I have found questions repeating. Asset in India, take it. Asset outside India, leave it. I'm only talking for non-residents. Asset being shares of a company which substantially derives its value from assets in India. Assets of a foreign company, shares of a foreign company which gets its value not because the assets are outside India, but even though you are selling the shares of a foreign company, but that foreign company's valuation is because of India. In that case, what is meant by substantial interest? The value, total value exceeds 10 crores and also it exceeds 51% of the total assets, or even 50% of the total asset. On which date will I measure? I will measure it on the balance sheet date. Suppose on the value after 9 months you are saying selling. 9 months kulla the value has exceeded by 15%, then whatever is the sale date value, only that date value will be considered. Is the class clear? Okay.
Sir,
Yes, Raja, I am listening.
5% of value is less than or equal to 5. அது எதுக்கு sir?
That is, if I am holding shares in a company and my holding rate is only 4%, and I am selling that company's share, that company derives substantially its value from India. That is an exception. Normally, I am a small shareholder. I'm not I'm a big shareholder. I'm a small shareholder. So less than or equal to 5%, it will not be taxed. That's what I meant by that.
Thank you, sir.
Okay, okay, right, sir, right, sir. My dear friends, then going into other sources. Then going into other sources. Okay, okay. In this case, gift, okay, received from by a non-resident from resident is taxable. Gift received by a non-resident or RNOR by a resident from a resident is taxable. In all other cases, that is interest, dividend, etc., okay, it is taxable if it is arising in from India or accruing or arising from India. That is okay. That is sorry, friends. Interest, dividend, or other things is taxable in India if it is accruing or arising from India or received in India. But one exception is if this company pays dividend, that is not taxable unless it is received in India. That is not only the capital gain part of it is taxable. If that company in which substantial share value is derived in India and they are paying dividend to a non-resident and he is receiving it outside India, that cannot be taxed in India. That cannot be taxed in India. Am I clear to you? Okay. So interest or dividend is taxable only if it is received in India or accruing or arising from an Indian company. Okay. Right. In this interest aspect, I asked you to remember some things. One non-resident gives loan to another non-resident outside India. Outside India, with a direction he invested in business or profession in India. This even though the entire transaction takes place outside India, for the person who is receiving interest, it becomes taxable because the loan is given with the direction that it should be utilized for business or profession in India. Okay. Whereas in the case of royalty or fees for technical services, if it is used in India, not even the word business or profession appears, it is taxable for the non-resident. If it is used in India, it is taxable for non-resident. In that one example I gave you, I give a loan to I am a non-resident, Srivel is a non-resident, I give loan to a Srivel and he uses it for purchase of shares in India or purchase of asset in India. That is not taxable in my hands. He pays me interest, that is not tax. He uses it for the purpose of business or profession in India. Now from outside India, he is paying me interest. That is taxable in my hands. That is taxable in my hands. Am I clear to you? Okay. Whatever I have spoken is what we have condensed and elaborately studied. But please keep it ringing in your mind. Business connection, capital gains, and this interest and all small things. Okay, keep ringing it in your mind. That is more than sufficient. That is more than sufficient. Okay. Now, my non-resident, எனக்கு நான் லோன் கொடுத்திருக்கேன் ஸ்ரீவேலுக்கு, எனக்கு இன்ட்ரெஸ்ட் வரும், அது எனக்கு டாக்ஸபிளா? நானும் நான் ஜெர்மனியில இருக்கேன், அவன் பிரான்ஸ்ல இருக்கான். எனக்கு நார்மலா இந்தியாவுக்கு இதுக்கும் சம்பந்தமே இல்லையே. ஆனா ஸ்ரீவேல் invest that money for business or profession in India, then it becomes taxable in my hands. It becomes taxable in my hands. That's what I meant. Okay. If Srivel is purchasing an asset in India, investing in shares in India, that and all is not taxable. If he is going to invest in business. But royalty wise, there is nothing. The word business, obviously you will use the royalty for business or profession. What else you are going to use the royalty? But that word business or profession is missing over there. Okay, friends. Okay, so please keep these things ringing in your mind. Okay, always. Okay, this is how it is taxed. Okay, so after that we proceeded to non-resident taxation. I will go further and come back reverse. I will go further and come back reverse. Okay, friends. In the PGBP arena, what I saw is presumptive computation. In the pre-GBP arena, I saw something about presumptive computation for non-resident. In that, I saw shipping, airline. These are the popular questionable area. These are the popular questionable area. Okay, those civil construction and mining are there, but the popular questionable area is these two things, 7.5% and 5% of the receipt. 7.5% and 5% of the receipt. What is receipt? If the commencement of the journey is in India, then wherever you receive it, it is taxable in India. If the commencement of journey is outside India, if the tickets are booked in India, then on the basis of receipt, it is taxable. Okay, that's what is the key factor. Here it is civil construction, 10%. 10%. Then there is something known as a 44C, which we saw, HO expenses, head office expenses, okay, actual or 5% of adjusted total income, whichever is less is only allowed. Adjusted total income is equal to business income plus brought forward losses. Okay, brought forward losses, brought forward unabsorbed depreciation. Okay, current year that capital expenditure for family planning. Current year capital expenditure for family planning alone will be added and found out, okay, as okay, basically it adds back all the brought forward items, unabsorbed items, etc. will be brought forward. Those things will only be added. Am I clear to you? Okay, this is about 44C. In that, there is one more thing which we saw is 44DA, royalty. Okay, this is a PGBP chapter computation. Sir, royalty is spoken about in section 115A also and 44D also. What is the difference, my dear friends? If the permanent establishment is in India, this section. If permanent establishment is not in India, 115A. That is the simple difference. Royalty is taxable in two places. One is 115A. I'm only talking about non-resident. 115A. Permanent establishment, my dear friends, permanent establishment is not there. 115A. Directly 20%, 20.8, you are paying it. Permanent establishment is in India. Compute it as business. Compute it as business. What I will take? Income minus all Indian expenses minus reimbursement. Okay. In other words, I will not take any allocated cost. I will not take any allocated cost or common cost. I will not take any allocated cost or common cost which is paid outside India. On this, I will compute. Whenever I am computing, I will tax it at a higher rate. So 40% if it is a company or individual. Okay. So from the top, I am repeating, business or profession chapter has some things. In this, please remember the three things which I am saying. Airline, 5%. Shipping, 7.5%. Head office expenses, actual or 5%. royalty. Very, very rarely they are asking. If the permanent establishment is in India, the computation will be like this. Am I so far clear to you? Am I so far clear to you? Okay, this is what we have been seeing in business or profession related. Okay, residential status, scope of total income, and business or profession. Now, in our notebook, once more, we are writing about rates of taxation for non-resident. Rates of taxation for non-resident. Okay, one by one, I'm asking you to write. Point number one. Okay, this is like when you are reading, you should understand. That's why. Okay, while doing capital gains, convert it into foreign currency, by applying the average of TT buying rate and TT selling rate. By applying the average of TT buying rate and TT selling rate. Full stop, continue. Reconvert it into Indian currency. By applying TT buying rate. Next paragraph. Okay. If the net consideration is reinvested within 6 months, provide exemption where partially reinvested, proportionate exemption. No benefit of indexation. So for capital gains of a non-resident, if he is investing in foreign currency, my dear friends, use this. Okay, use this. Okay, shall I proceed? Okay, interest as the heading. Under that, if it is infrastructure investment, 5%. Always we will add HEC also. So it will be 5.2%. Okay. If it is infrastructure investment, 5.2%. Next. Any other interest on foreign currency? Any other interest if investment is in foreign currency? Any other interest if investment is foreign currency? 20.8%. That is 20% plus 4% of that. You can write the base rate itself, I don't mind. Okay, 20.8%. Is the class following? 20.8%. Third. Okay. Okay. This is that's all for interest. That's all for interest. But one other aspect. Third, interest for units located in IFSC, 9%. Interest for unit located in IFSC. IFSC is never questioned, so don't worry about it. 9%. Okay. In this, I ask you to remember something. Okay. A Indian company allotted 20 lakh debentures for a foreign company for conducting fees in lieu of fees for technical services. For that debenture, they are paying interest. Okay, it is taxable at normal rate. It is not taxable at normal rate for the foreign company because they have not bought money into India. Only if the investment is in foreign currency, only if the investment is in foreign currency, that extra benefit, that 20% rate will come. Otherwise, it will be only because in this case, debentures are allotted for fees for, so they have not brought in any money. Are you clear? Dividend. From a business trust. Okay, 10%. Other dividends, 20%. I'm not adding surcharge, HEC, 10.4, 20.8 otherwise. Other dividends, 20%. Okay, again, investment should be in foreign currency. Okay, next, dividend from a business trust. And the business trust has earned it from an SPV. Dividend from a business trust, and the business trust has earned it from an SPV, which is following normal tax regime. Example, which has opted out of, okay, which is following normal tax regime, nil. It is not taxable. So dividend from a business trust, normally 10%, but one exception is this one. Okay, all other dividends are 20%, be it mutual funds or anything. Royalty and fees for technical services. Okay, under that, if it is in pursuance of an agreement, approved by the government, normal approval only, don't worry, hyphen 20%. So please remember, you should add 20.8. Note, if DTAA gives a lesser rate, then that rate will only prevail. If DTAA gives a lesser rate, then that rate will only prevail. So far clear? Okay. Some questions, if they have, in one of the questions I saw, now, okay, royalty from an Indian enterprise, 20 lakhs. They are given two answers. I don't know, 20.8. However, if it is not approved by the government, the agreement not approved by the government, 40%. Okay, I don't know why they gave that, but they have given that answer. Because I don't think there is anything without an approval. Okay, but anyhow, next. Long-term capital gain, 10%. Long-term capital gain, 10%. Always LTCG, 10%. You can be sure of. LTCG, 10%. Then GDR. Okay. GDR. Global Depository Receipt, and RDB, rupee denominated bonds. Global Depository Receipts and RDB. Under that, dividend, interest and capital gains, 10%.
Sir, repeat.
Global Depository Receipt, GDR, and RDB, rupee denominated bond, be it dividend, be it interest, be it capital gains, everything 10%. Okay. No, after all these things, now the rates are over. Under that, note, special rates are the same. That is 111A is the same. 112A is the same. That is first 1 lakh not taxable, remaining 10%. Okay. Okay. Other capital gains where I am using the indexation 20%. Special rates remain the same. Winnings 30%. Okay. Now, sports persons and heading. Sports persons and performers. That is show performers. Sports persons and performers. Under that, participation, comma, advertisement, comma, contribution to news article. Participation, advertisement, contribution to news articles, 20%. Okay, only these three. If they have any other income, okay. In all these cases, I am writing a note. In all the above said cases, in all the above said cases, in all the above said cases, where this is the only income of the non-resident, where this is the only income of the non-resident, and tax has been deducted, where this is the only income of the non-resident and tax has been deducted, assessee need not file returns. Assessee need not file returns. Okay, this apart. Okay, in CA I have told you they have asked about foreign financial institutions. 115 AD, CA they have asked once, but CMA has not yet questioned. But I want you to remember their STCG other than is taxable at not normal rates but 30%. Okay, infrastructure 5%. Okay, 20% in the case of dividend, etc. Others rates are the same. Only different is their STCG, because they always traded, is taxable at 30%. Okay, 115 AD alone while doing the material. Okay, before going to the examination, please see this rates once. Before going to the examination hall, please see this rate once. Okay, so I'm happy that we are able to complete the theory within 1 hour. Okay, so please remember these things. Okay, and with this the question will be straightforward and simple of working. Straightforward, you have to directly put the tax and identify it. Okay, right? I'm going to the material. Non-resident taxation. I'm there in the question number 9 of the material. The following information pertains to Mr. Approve, an Indian citizen and non-resident. Okay, is a non-resident. Dividend from an Indian company, so we know it is taxable at 20%. Interest on debentures of SLP private subscribed in foreign exchange, we know it is taxable at 20%. He incurred interest on loan taken for purchase of TPO Limited and for purchase of debentures of okay, none of the expenses will be allowed. None of the expenses will be allowed. None of the expenses will be allowed. Always, if the rates of taxation are special, be it for a resident or non-resident, expenses will not be allowed. Okay, winnings, they will not allow expenses. Okay, any rates of tax, 115 BBF, 115 means you are not allowing expenses. On 15th March 24, he sold the shares of Fixed Limited, which were subscribed in convertible foreign exchange in for 4,65,000. He paid commission to the broker 7,000 at the time of sale. On 30th April, he invested 4,80,000 out of it. So 1825 minus 7,000. Okay. Based on the questions, choose the appropriate answer. What is the amount of dividend taxable in the hands of Mr. Approve, and at what rate TPO Limited has to deduct tax at source on dividend income? This is 1,30,000 at 20.8%. Always, if it is non-resident, they will add the HEC also. If it is resident, they will not add. If it is non-resident, it is taxable along with HEC, so that he need not file his return. Assuming for the purpose of this MCQ, Mr. Approve is a resident in India for the previous year. Determine the amount of dividend taxable in the hands, and at what rate TPO Limited is required to deduct tax at source on dividend income distributed. 10%. 10%. Now I want the class to understand this. Now, okay. He incurred interest on loan taken for purchase of shares and for purchase of debentures. So interest on loan taken is 30,000. 30,000. My dear friend, for a resident, the allowability is like this. Dividend less interest will be actual or 20% of dividend, whichever is less, he can claim it. Okay, in this case, the answer is straightforward, 10%, because the question asks what is the tax to be deducted at source. Okay, it is 10%. But what is the amount that is taxable in the hands of Apur? I'm just asking you, what is the amount? I'm just answering that. Okay, dividend is 1,30,000. Dividend is 1,30,000, my dear friends, less actual interest is some 30,000, I believe. Okay, actual interest is he incurred interest on loan taken for purchase, and for purchase 30,000. Okay, actual is 30,000. 20% of interest comes to 26,000, right? 26,000. 26,000 can be claimed, and 1,04,000. Sorry. So this will be the, because the question asks determine what amount of dividend is taxable in his hands. So B is the answer. B is the answer. Though 10% on the face of it, you will find it as the, but 10% the amount taxable in his hands is 1,04,000. Remember, for dividend for a resident, they can claim only interest as the deduction, not collection charges. Only interest as a deduction up to 20% of dividend receipt. B is the answer. What is the amount of debentures of SLP is taxable in the hands of Mr. Approve, at what rate? So what is the debenture interest? Interest on debentures subscriber 1,35,000, 20%. 1,35,000, ignore surcharge and cess. 1,35,000, 20%. Sorry friends, there is a page alignment mistake. There is a page alignment mistake. What would be the amount of long-term capital gain taxable in the hands of Mr. Approve on sale of debentures of Fixed Limited as per the provisions? Ignore the first provision. Obviously, ignore the first provision of 48, benefit of foreign currency conversion. Question number 4, my dear friends. Question number 4. Okay. Full value of consideration. Just I'm doing the, you can do it roughly. 18,25,000 less cost of transfer. They have paid commission of 7,000. Net consideration less cost, no indexation anyhow. Friends, for a resident, no indexation for debentures. For a resident also no indexation. For a non-resident, always no indexation. Less cost, 4,65,000. Gross LTCG less investment. Okay, they have invested 4,80,000 within 6 months. 4,80,000 within 6 months. Okay, not entirely invested. So 4,80,000 into 1,353,000 divided by net consideration. Repeating, 4,80,000 into this divided by, okay, so I am getting D 995,772. Okay, assuming for the purpose of MCQ that Mr. Apur is a resident in India, what would be the amount of taxable capital gain on sale of debentures? Straightforward, my dear friends. The exemption kadayadu. This is only for non-resident because they should not repatriate the money. So there is no indexation benefit also. 1353. 1353. If it is a resident, direct computation. No indexation benefit. Reinvestment la kadayadu. Only thing is 54F. Where if he purchases a house property using this, then you can again net consideration as the weight investor. Shall I? Okay. Mr. Albert, a non-resident and American citizen, is employed in an American company. The American company has a permanent establishment in India. Albert visiting during the financial year on official work and stayed for 80 days. His salary for that period, 25 lakh, is borne by the Indian permanent establishment. Albert held 1,200 shares of Shine Private Limited, an Indian company, which he acquired for 35. For acquiring the shares, he remitted $50,000 on 15/12/2018. He sold these shares during the previous year for 63. Albert also held 2,000 equity shares of YOC Incorporation, an American company, which he had acquired in dollars in 2018. YOC Incorporation follows April to March as its financial year. He sold all these shares for dollar equivalent $6.15 per share to another non-resident. The relevant information of YOC Incorporation is total assets, total value of immovable assets worldwide, immovable properties held in India, which is 8 crores. Dividend from YOC Limited received in India is 1,32,000. You are required to compute the total income and taxable in India of Mr. Albert, ignoring the provisions of DTAA. Exchange rate, what is the date of investment? 15/12/2018, 66, 68. So I will get 67. And date of sales is 20th August 1992. I'll get 91. Okay, read through the question once. Nice question. Okay, shall I, friends? Shall I compute capital gains as a working note? Question number 2. Question number 1. You want some hot water? Okay, okay, my dear friends. My dear friends. Okay, he has sold the shares for 63. How many shares? For acquiring he 1,200 shares. Okay, amount actually in dollars. Full value of consideration. I'm taking it as 1,200 into 63 divided by 91. Average rate 91 dana. Okay, average rate is 91. Okay, less cost of acquisition, which he had acquired for 35 per share. 1,200 into 35 divided by on 15/12 to the 31/12/2018. Sorry, he acquired since okay, an Indian company since 31/12. He acquired it for 35. So 31/12/2018. Sorry, not this. This one. 69. 69. May I, friends, may I? Now, I want you to understand about this information. Again, they have given. Albert sold 2,000 shares of YOC Incorporation, another company, which he had acquired in dollars. YOC Incorporation follow April to March, and he has sold it for 615, another non-resident. The relevant information are total value of assets, value of immovable property. Value of immovable property in India is 8 crores. To check whether substantial value of asset is in India for a foreign company, two conditions are mentioned. Okay, value should exceed 10 crores. Okay, more than 50% is value is derived from Indian assets. In this case, the value of Indian assets has not exceeded 10 crores. Hence, this need not be tested. Albert, a non-resident, is employed in an American company. During the visit, he is paid a salary of 25 lakhs. Now, I am going to write this so that I'll write it and then explain. Okay. Salaries. Okay. Please take your time to understand this. Taxable at a place where services are rendered. However, one exception law provides is if the employee is in India only for less than 90 days, then accrual of salary will not be taxable in, please wait till I complete, in India. Okay, 90 days varaiko they are temporarily coming into India, so they are not saying. However, in this case, salary is not paid by the foreign company. It is paid by the Indian PE. So, irrespective of the period, it is taxable in India. You are understanding? You are understanding? Normally up to 90 days they will not. But in this question, you can see, okay, Albert visited on official working for 80 days. His salary 25 lakhs is borne by the Indian permanent establishment. Is borne by the Indian permanent establishment. So, okay. Somebody was pinging. So if somebody has a question, please don't ping me. Just take your and
Sir, the screen is very blurred, sir. Screen clearer, Allah, sir. Disturb.
சார் அப்படியே அந்த மெட்டீரியல் கொஞ்சம் குரூப்ல போட்டா ஈஸியா இருக்கும் சார் கொஸ்டின் ஃபாலோ பண்றதுக்கு.
ராஜா போட்டுட்டேனே ராஜா.
இன்னி
இல்ல
ஓகே
நேத்தித்தது
சரி
இன்டர்நேஷனல்
ஓகே
டாக்ஸேஷன் ஃபுல்லா போட்டுட்டேன் ராஜா நேத்தியே.
ஓகே ஓகே சார் ஓகே தேங்க்யூ சார் செக் பண்றேன் சார் தேங்க்ஸ்.
எல்லாருக்குமே பிளர்டா இருக்கா?
Yes.
Friends, if the blurriness continues, let me know. Okay, so I was just saying that in this case, even though it is 80 days, but since it is paid by the Indian PA, it becomes taxable. Gross salary is 25 lakhs. Standard deduction, okay, 50,000. And remember, the standard deduction can be claimed even under the concessional tax regime, okay, 2450, okay. And then we have capital gains. My dear friends. Janani, continue agudha blurriness.
Yes, sir. It is still blurred. Yes, sir.
Actually, the first floor தான் கரெக்டா இருக்கும். I don't know அதுல எப்படி blur வருதுன்னு. Let's see. In 2 minutes, I'll again check it out. Okay, capital gains, okay, on sale of debentures. Actually, LTCG on sale of debentures. Is it clear? Okay. Total income தான் கேட்டிருக்காங்க. So no problem. Tax கேட்டாங்கன்னா இது மாத்திரம் taxable at special rate. Okay, மிச்சதெல்லாம் general rate. Individual. இப்படியா கண்ணு பிளட் இன்னும் பிளட்டா இருக்கு காமிங்க. Falcon Limited of Country X is an AE of Max Incorporation of USA. Falcon Limited has a branch in India since 2010. It was selling goods to Indian customers by importing from various countries besides sale of in India of goods manufactured in country X. The adjusted total income of the Indian branch of Falcon Limited is 80 lakhs. Branch incurred 12 lakhs by way of executive and general administrative expenses. The head office has allocated 18 lakhs as the branch share of head office expenditure, including the expenditure of 12 lakhs. A survey was conducted in the premises of the branch and undisclosed asset 90 lakhs were identified. Assessment for the assessment year 23-24 was completed by making addition of the entire 90 lakh. The assessee preferred appeal before CAT appeals, who gave complete relief to the assessee. Income Tax Department want to file an appeal. T Private Limited, an Indian company, a wholly owned subsidiary of Falcon, paid 50 lakhs to XYZ Incorporation of Country M as fees for technical services. Services were rendered by the employees of the branch of XYZ Incorporation in India. There is no DTAA between country India and country M. TP Private Limited has entered into certain international transactions during the last 2 years. T Private Limited invested in SS Private Limited of country Y and received a dividend of 550 lakhs during the year. It declared and distributed dividend of 250 lakhs on 10/11/23 and final dividend of 230 lakhs on 12/11. T Private Limited has filed its return of income on 15th November and 30th November. Based on the facts of the above case scenario, choose the most appropriate answers. Read the question once more. Let me break down the question again. Okay. The adjusted total income is 80 lakhs. 5% of 80 lakhs is 4 lakhs. Okay. 5% is 4 lakhs. Or the head office expenditure of 18 lakhs, whichever is less, 4 lakhs. Survey for which Income Tax Department want to go on an appeal, yes, they can. More than 50 lakhs, they can go on an appeal. They can go on an appeal. Wholly owned subsidiary, 50 lakhs as fees for technical services, 20.8%. 20% is the tax, 8%. Okay. Received a dividend of 550 lakhs. Okay. ATM. If you have distributed that at least 1 month prior to the due date of filing returns. Due date of filing returns may be 31st October. Before 30th September, you should have declared 250 lakhs allowed. Interim dividend allowed. Final dividend, this you cannot allow. This you cannot allow. So 550 minus 250. 250 is ATM. Read through now. (23-24) financial year ku na return 31st October file pannom. 1 month before na I should have distributed the dividend on or before 30th September. but I am doing it only in, so you cannot claim it. 10, 11, 23. அதை எடுத்துக்கலாம். Let's answer. How much is the tax deductible on fees for technical services? 20.8% of 50 lakhs, my dear friends. 50 lakhs, huh? Yeah. 50 lakhs into 20% comes to 10 lakhs. Add 4%, 10 lakhs, na? 10 lakh 40,000. Na? Okay. 10 lakh 40,000. How much of the dividend received by T Private Limited would be taxable? This is what? 550 minus 250. 550, 80 M is 250. So 300 lakhs. My dear friends, please write and keep. Okay. 230 lakhs is distributed only in November 24. So cannot be claimed. How much of head office expenditure can be claimed by the Indian branch of the Falcon Company? 4 lakhs. 4 lakhs. Just now we saw 4 lakhs, 5%. Can the income tax department go on an appeal? Yes, my dear friends. Yes, my dear friends. Yes, as the tax liability is more than 50 lakhs. I'll come to question number 4 later. I'll come to question number 4 later. Okay. I'll give you the break by 8 o'clock. That is not the breakfast break. That is a normal break. Okay. Whatever feedback you have, you can send it now. இதான் ஒரு ஃபர்ஸ்ட் ஃபீட்பேக்காகவே வந்தது. இன் பிட்வீன் கிவ் அஸ் அ பிரேக்னு படுவா இவன் தான் கொடுத்து அமைச்சிருக்கான்னு இப்போதான் எனக்கு தெரிஞ்சது. ஓகே. நான் கூட ஏதோ கொஸ்டின் தான் வருதுன்னு நினைச்சேன். அஃப்கோர்ஸ் ஐஸ்வர்யா has sent me a question to answer. But otherwise ரொம்ப நன்றிடா ராஜா. Okay. Strawberry, a non-resident German company, has the following incomes in India. Dividend income 12,50,000 from an also non-resident German company. Fine. Dividend income taxable at 20%. 8% debentures of 20 lakhs received from X Limited and on October 1st as consideration for providing technical know-how. It will not be taxable at that special rate. It will. Technical know-how is also an income, and this is also an income. Okay, this is what I said in this question. They have put 40% tax for technical know-how, saying the words in pursuant of an agreement with government is missing. Okay. Dividend of 5,50,000 on GDR, 10% taxable, issued under a scheme of central government against the initial issue of shares, etc. Business income 8 lakhs from a unit established in Mumbai. Income by way of royalty other than that referred to in 44DA, which means amounting to 10 lakhs from Z Limited, an Indian company, in pursuance of an agreement approved by central government. So they consider the technical fees, their words are not there. Okay. As per DTAA of both these countries, royalty is taxable at 22%. Now our rate is better, 20%. Give B statement of the statement of the above income. You are required to compute the tax liability of the company. Just read it.
It is clear now, sir. Clear, sir.
Okay, thank you. Interest income on debentures. Okay. 20 lakhs into 8% into October 1st, 23, 6 by 12. I'll come to technical know-how. I'll come to technical know-how separately. Okay. Dividend from GDR, dividend from global depository receipt, 5,50,000. These are basically IFOS. That's why I did it separately. Okay. Now for my business income. Business income in Mumbai, $8 lakhs. Royalty for royalty under an agreement. So surcharge will not come. Surcharge will not come. Their income is less than 15. 1 crore, less than 1 crore. Dividend from GDR taxable at 10%. Other dividend taxable at 20%. Investment in foreign currency தானே. Now for the fix for technical services, I'll just take whatever they have done in the and then write the note also.
சார் இன்கம் ஸ்டேட்மெண்ட் கொஞ்சம் மேலே
Are you clear? All of us? This is clear, right? Okay. Question number 6. TIP Incorporation, a foreign company headquartered at Malaysia, has a branch in India. TIP Incorporation, a foreign company headquartered at Malaysia, has a branch in India. The branch has shown a net profit of 28 lakhs after charging the following: depreciation, unabsorbed depreciation, capital expenditure incurred for promotion of family planning, 7 lakhs is 1/5 of the expenditure, scientific research expenditure, business losses brought forward, deduction under Chapter 6A, head office expenses allocated to the branch. Compute the total income to be declared by the branch. Read through. net profit 28 lakhs. And you will not add current year depreciation, unabsorbed depreciation adjusted, because all these things, the question says after charging all these things, 17 lakhs. Don't add back scientific research. It's allowed. It's a current year expenditure. Nothing to do with business chapter 6A deductions. 20 lakhs. HO expenditure 120 lakhs. Okay. Computation of income. Existing net profit add HO expenses debited less HO expenses allowed taxable net profit. Done. Done. Okay. Mr. Aryan, a non-resident, received foreign currency equivalent to 85,000 from his resident friend. Okay. The same was paid by such resident from his bank account in country X. No problem. For the receiver, it is taxable and received by Aryan in his bank account outside India. The friend also gifted a gold chain, fair market value 95,000. Are the gifts received by Mr. Aryan taxable under Income Tax Act? Yes. Gift received by a non-resident from a resident is taxable irrespective of the place of receipt of gift. Irrespective of the place of receipt of gift, 85 plus 95 comes to 1,80,000. 1,80,000 taxable. $1,80,000 taxable. Okay. Question number 8. USA Airlines Incorporated as a company in USA operates flights to India and vice versa. During the year 23-24, vice versa during the year 23-24, and collects 150 lakhs for carriage of passenger and cargo, out of which 90 lakhs were received in US dollars for passenger fare booked from New York to Mumbai. The total expenses was 195 lakh. Income chargeable to tax of the foreign airline may please be computed. Will your answer change if the fares are booked in India or paid in India? Yes. Yes. Commencement of journey is the place of accrual. Okay. If the income is received in India, irrespective of commencement, it becomes taxable in India. Case A. Okay. Commencement from India will be 150 minus 90. Okay, 60 lakhs. Income at the rate of 5%. 3 lakhs. Case B. Commencement Question number 9. My dear online friends, question number 9. Miles Incorporation, a company incorporated in US, is engaged in development of infrastructure and providing consultancy in the same field. For the financial year 23-24, its shareholders met in India for 3 times. The first 2 meetings were held to discuss the modification of right attached to various classes of shares, and the 3rd meeting to decide about the sale of company's asset located in India. The meeting of board of directors are held in Chicago, USA, where management and commercial decision necessary for the conduct of business are taken. It provides the following information. Dividend received 5,50,000 net of TDS on GDR of SZ Limited, an Indian company issued under a scheme of central government against the initial issue of shares of the company and purchased in subscribed in foreign currency. Fees for technical services from Government of India. The Government of India utilized the technical services for development of a project carried out in Nepal. You are required to determine the RS of miles and compute the total income, briefly explaining the relevant provisions. Read through. Miles Incorporation is incorporated outside India. The only test is whether the poem is in India. To determine poem, the first criteria is where the board of directors meetings are held. To determine poem, first I have to check where is that board of directors meetings are held, where the board of directors meetings are held, where it is, okay, where majority of meetings are held in India, then poem is in India. But in this case, all meetings are held outside India. Hence, poem is not in India. Note, shareholders meet is never an criteria. Hence, Miles Incorporation is a non-resident company. Dividend received net of TDS on GDR. Dividend grossed up. First I am computing the income. 5,50,000 divided by 89.6, correct? It is a GDR. So 10.4 is the tax. What I would have received net is 89.6. Okay, 89.6 into 100. For GDR, rate is 10%. And HEC 4% of 10%. Okay, 5,50,000 divided by 89.6 into 100. They have not asked the tax. If they asked 10.4, 20.8. Shall I? XYZ, an Indian company, is engaged in the business of manufacture and packaging material, having its manufacturing facility in India. XYZ is a wholly owned subsidiary of Flix Incorporation, a company incorporated in country M. Angelo and James, citizens and residents of country N, each hold 50% share capital in Flix Incorporation. Angelo and James each had invested equivalent to 100 crores in Flix in April 2015. In June 2023, Angelo and James, having received an offer which they believe was fair, sold their stake in Flix Incorporation to Ishan, a resident in country N, for an amount equivalent to 350 crores each. The accounting period of Flix Incorporation is Jan to December. The relevant extract of the balance sheet as on 31st December 22, 1st June 23 and 31st December 23 as or follows. 1000, 1300, 1500 liabilities, FMV of the asset without reducing liabilities, details regarding investment in XYZ, cost of acquisition, book value of assets in the balance sheet, liabilities, FMV of assets without reducing liabilities. Determine whether the income arising from transfer of shares chargeable to tax in India in the hands of Angelo and James, assume there is no DTAA between M and N. Read through. Reading from the top, XYZ company is engaged in the business in India. It is a fully owned subsidiary of Flix Incorporation, a foreign company. Okay. Okay, leave around on 1st January, on 1st June, they are selling. The accounting period of Flix Incorporation is January to December, and the shares are sold on 1st June 23. Details of asset, it has increased more than 15%. It has increased more than 15%. I should not take the liabilities. I should only take the assets. 1300. 1,300. Details regarding investment in XYZ, cost of acquisition 150 crores. Book value of assets in the balance sheet of XYZ and Co. not needed. Okay. Book value of assets in the balance sheet, liabilities, fair market value. Determine whether the income arising from transfer is chargeable. When this will be chargeable? If the book value exceeds 10 crores and more than 50%. Okay, right? Capital gains in the case of shares of a foreign company. Capital gains in the case of shares of a foreign company. For a non-resident, it is taxable in India if the following two conditions are fulfilled. Value of asset exceeds 10 crores. Value of assets in India exceeds 10 crores. Value of Indian assets constitute at least 51%, 50% of it. Date of last balance sheet. Sorry. Date of last balance sheet. December 22. Asset value. Okay. Only asset, not net asset. As on balance sheet, thousand crores. Asset value on the date of sale, 1,300 crores. Exceeds 15%, hence 1,300 crores should be considered. Hence 1,300 crores should be considered. Okay. Okay. Are you clear with this? Are you clear with this? 100% of shares of XYZ Limited is held by Flix Limited, Flix Incorporation. Value of 100% of shares as on 1st June, as on 1st June 23, value without reducing asset is 600. Value without reducing liability. Hence, it exceeds a, oh no, it does not exceed. It does not exceed 50% of total asset value. Sale by Angelo and James are not taxable in India.
சார் சார் இந்த 600 போட்டிருக்கீங்க சார், அது என்ன ப்ரொவிஷன்?
FME of asset without reducing liabilities. 100% of my company is owned by the other company. So whatever is my asset belong to them.
ஓகே சார்.
Okay, friends. Okay. There is one question which I left and came. Question number 4. Okay. 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 Last night I stood upside down, but I couldn't find that answer. I think the answers given are completely out of sync. I'll read the question. Smart Incorporation country X advanced 10 million US dollars on 1st June 23 to Kite Private Limited India in foreign currency. Kite Private Limited accepted the loan amount under an agreement approved by the central government. The loan carries interest at the rate of 9% per annum payable in foreign currency. For the financial year, Kite paid the interest after deducting income tax. The TT buying rate on the date of loan and on the year-end date is given. What is the income tax liability of Smart Incorporation for assessment year in respect of interest earnings in foreign currency by Kite Private Limited? So 20.8%. 20.8%. Okay. Value of loan in USD comes to 10 million. 1 million is 10 lakhs. 10 million is 1 crore. Value of loan in USD is 1 crore. interest at the rate of 9% for 10 months, correct? From 1st June 23 into 9% into 10 by 12. 7,50,000 US dollars. Interest in INR taking rupees 70. Okay. Date of paying interest. 7,50,000 into 70. 5,25,000. 5 crore 25 lakh. Interest at the rate of 20.8%, which will also be the TDS. 1 crore 9,20,000. Kitta kuda illa answer. Kitta kuda illa. Then I tried 5.4 also. Interest at the rate of 5.4%. Okay, thinking whether it's infrastructure they have taken it as. That also not showing the answers. Okay, I somehow feel that the options given are completely out of place. Okay, that the options given are completely out of place, but I don't. நான் ரிவர்ஸ் ஒர்க்கிங் கூட பண்ணி பார்த்தேன். அவங்க கொடுத்த ஆப்ஷன்ல எல்லாத்தையும் ரிவர்ஸ் ஒர்க் கூட பண்ணி பார்த்தேன். லோன் அமௌண்ட் டேலி ஆகுதான். None of the answers even come near to it. So I think there is a mistake in the options given. There is a mistake in the options given. Actually, this will not come unless the infrastructure is there. One minute. Oh my God. Okay, I get the answer now. I get the answer now. Sorry, friends. I'm very sorry. Okay. Interest at the rate of 20%. I mean, tax at the rate of base time. Night ரொம்ப நேரம் work பண்ணிருந்தேன் நான் இதுக்கு. I spent long time for this. Now I got it. And surcharge, because I know that income exceeds 1 crore but not exceeding 10 crores, 2%. HEC at 4%. One lakh 11,38 for him. Sorry, I was blindfolded on surcharge. Suddenly now I saw 5 crore 25 lakh. Probably they have put surcharge because they have to put surcharge if it exceeds 1 crore. சொல்லுங்க. எந்த one word? நேத்தி சொல்லிட்டேன் காத்தால். நேற்று ஒரு மிஸ்டேக் பண்ணிட்டேன். நான் 3.5 இல்லை, அது 3.25. நான் 3.5 ஆட் பண்ணேன். SBI rate plus 3.25. நான் காத்தால 3 கொஸ்டினுக்கு கரெக்ட் பண்ணியிருக்கேன். கொஞ்சம் வீடியோவோட ஃபர்ஸ்ட் 10 minutes பார்த்துருங்க. ஓகே. Am I clear to you? Okay. So yeah, thank God. I got it. So there are two things, section 90 and 91. 90 talks about bilateral relief, that is where there is an agreement. 90 talks about two things, income exempt method, tax credit method. Income exempt method means the income earned in the other country is not taxed in our country, or vice versa. Tax credit method means the tax that is paid outside India should be given as a credit. DTAA chapter is for a resident assessee for foreign income earned. NR chapter is for a non-resident assessee for Indian income earned. DTAA is the vice versa. Okay. Section 91, unilateral relief. That is where there is no agreement. The resident country has to give the benefit, relief. Relief will be average tax. Relief will be average tax or average tax in India or tax paid outside India as a percentile, whichever is less, into doubly taxed income. Okay, sure question. Not a question paper without DTAA, and it will be simple, straightforward. Remember, a thing which cannot be missed. A thing which cannot be missed. Online students, is the screen clear? All well?
Yes, sir.
Yes, sir.
Let's go into DTAA. I have taken the 3 questions, or what, for 3 or 4 questions, which are really very detailed. Okay, so that the highest is taken care. Mr. Satak, an Indian citizen aged 51, left India for the first time to settle in country. Why? But owing to personal unavoidable circumstances, he returned back on 1st June 23. He has a residential property in country Y, from which he earned an income of 32,000 for the year ended 31st March. He is eligible for a basic exemption limit of 9,000, and the balance income he paid 20% tax in country Y. The tax was paid from his bank account in India. His income from business in India for the year ended. He is also receiving dividend of 225 from an Indian company and interest on savings account. 80 DTAA if he is not opting out of, if he is opting out of. The exchange rate on various dates. Okay, compute the net taxable, the net tax liability of Mr. Satak in India for the assessment after providing for relief under section 91 on the assumption there is no DTAA. Assume that Mr. Satak has opted out of section 115 BAC. Read it. income from house property. House property. Net annual value $32,000 into on that date 75. Standard deduction at 30%.
Um,
Yeah, go ahead with your question.
so the exchange rate as on 31/3/24, 75 less, sir.
Once more.
நம்ம வந்து any week consider பண்ணிருக்கோம்ல சார்? இல்ல சார், 31/24.
The property which he has earned
Sir,
income for the year ended 31st March 24. Okay, 1423 is 74. This is and this is on 30th April on which I think he has paid tax, etc. So we can consider 75.
okay.
Any income taxable at a special rate? No. So this minus 10 lakhs into 30% plus 1,12,000. Shall I? Average rate in India 5,93,892 divided by 25 lakh 28,500 into 100. Repeating, this divided by this into 100. Okay, maybe I'm getting some 23.49. 23.49. I want you to first understand what I'm working now. Okay. Tax rate outside India. Please listen to what I am saying. The question says, in the country in which there is a house property, basic exemption limit is 9,000 and the balance he has paid 20%. The balance he has paid 20%. Now understand. Tax rate outside India, okay, earning in foreign currency, earning in dollars, okay, 32,000. Okay, 32,000. Basic exemption limit of that country, okay, basic exemption limit of that country, 9,000. Taxable income, okay, please listen first, 23,000. Tax at 20%, 23,000 into 20%. Therefore, tax rate is 4,600 divided by 32,000 into 100. 4,600 divided by the income into 100. Tax rate in that country is 14.38%. Okay, very carefully. We cannot take it as 20% because that country has given a basic exemption limit. The tax he has paid in that country is lesser. So you should only consider this. Am I clear to you? Take it down.
Sir, 16,80,000.
Doubly taxable income is after providing standard deduction. So 16,80,000. Pakka clear? Pakka clear? Shall I proceed? 1680 எப்படி வந்ததுன்னு கேக்குறீங்க. ஆஃப்டர் நீங்க ஹெச்பி போட்டிருக்கீங்களே, ஸ்டாண்டர்ட் டிடக்ஷன் போக ஹெச்பி 16,18,000. Mr. Mani Prasad, aged a senior citizen, gives you the following particulars. Income in India, pension from state government, STCG, deposit in PPF, speculation income. Income outside India, agricultural income, dividend from a country incorporated in M, dividend is exempt in that country. Country N, business loss, proprietary business not eligible to be set off against any other income in that country. Gross rental income from house property, no statutory deduction is provided. Municipal taxes paid. Additional information. There is no agreement under section 90 with both the countries. Mani Prasad is a resident in India and he has paid applicable taxes on income earned in country M and N, which are 10% and 5% respectively. Compute the total income and net tax liability after providing for relief. Mr. Mani Prasad is paying tax under concessional tax regime. You cannot claim that PPF 80C and 80C deduction. And that senior citizen benefit of extra any of 3 lakhs is not going to be taxable, but still read through friends. Very carefully to be worked. Let's go headwise. Salaries, pension received, If you have a speculation loss, that cannot be set off against the business income. But if you have a speculation income, business loss can be set off against that.
Sir,
Yes, Kannu.
sir, screen வந்து மறுபடியும் வந்து blur-ஆவே இருக்கு sir.
For everyone?
Yes, sir.
Yes, sir.
Sir, foreign country speculation loss இருந்தாலும் set off பண்ணலாமா sir?
Raja?
Foreign country speculation loss நம்ம இந்தியன்
Set off பண்ணலாம்.
ஓகே சார்.
Hopefully it will be better now. Capital gains. Only in our country, STCG on sale of. Just check it out. There are no special rates. It's only STCG. So there are no special rates. Okay. No, so it's a new tax regime. It's new tax regime. First 3 lakhs nil. Next 3 lakhs 15,000. Next 3 lakh 30,000. So 6, 9. the balance into 15%. The balance into 15%, that is this minus 9 lakhs into 15%. In country M, please understand, agricultural income is only taxable, dividend is not taxable. Dividend is not taxable. So 86,000 into 7.48%. Repeating, 86,000, you cannot take dividend income, into 7.48%. Here in country N, I will take income minus this business loss which I have claimed. Income minus business loss, the house property income minus business loss. That country might not have set off, but we have set it off. My house property income comes to 2,09,300 minus 1,16,000. 2,09,300 minus 1,16,000 into 5%. Repeating, 2,09,300 minus 1,16,000 into 5%.
சார்
Raja?
அந்த பிஸ்னஸ் லாஸ் தான் ஆல்ரெடி நம்ம ஸ்பெகுலேஷன் இன்கம்ல நம்ம வந்து நம்மளோட இதில் மைனஸ் பண்ணியிருக்கோம். அகைன் நம்ம ஃபாரின் கம்பெனியோட
அந்த பிஸ்னஸ் லாஸ் ஃபாரின் பிஸ்னஸ் ஓடிய லாஸ், அதுக்கு அவங்க டாக்ஸ் பிடிச்சிருப்பாங்களா ராஜா?
இல்ல சார்.
ஸோ நாம ஒரு பெனிஃபிட்டா அதை கிளைம் பண்ணோம். Unless we reduce it, because நான் ரெடியூஸ் பண்ணியிருக்கேன். நான் கண்ட்ரி என்லேன்னு வந்த 2,09,300 டாக்ஸ் பண்ணல. 1,16,000 மைனஸ் பண்ணிட்டு தான் எனக்கு இந்த 82,995 வந்திருக்கு. ஆனா 1,16,000 நான் ஐஎஃப்ஓஎஸ்ல மைனஸ் பண்ணல, பிசினஸ் ஆர் ப்ரொஃபஷனல். ஆனாலும் இட் ஹவ் கிளைம் தட் பெனிஃபிட். ஸோ கண்ட்ரி எண்ட்லே நான் டாக்ஸ் பண்ற இன்கம் 209,300 கிடையாது, மைனஸ் 1,60,000.
ஓகே.
Okay, friends. Okay, we'll complete one more question of DTAA and then take the break. There's only 3 questions of DTAA, 4 questions. Then we'll complete all the 4 and then take the break.
So 1 minute answers.
Whichever is less, average rate in India or tax rate of the other country, whichever is less into doubly taxed income. Compute the total income and net tax liability of Mr. Nitin, an individual resident in India, from the following information. Nitin earned a royalty income of 18 lakhs from country X for writing articles in journals and newspaper. However, he's received only 13,60,000 during the previous year and the balance is outstanding. He maintains cash system of accounting for royalty. He also earned a rental income of 3,60,000 from a house located in country X. MT paid 12,000, which is not allowed as a deduction in that country. No problem, I will allow. No DTAA exists. Country X, all incomes are tax chargeable at 15%. He further earned 5,50,000 during the year as dividend from an Indian company. On 1/4/23, he took an educational loan for his son who is pursuing MBA. Repayment of loan and interest is 36,000. Assume he has opted out of default tax regime. Very simple, straightforward question. Whatever is received is only taxable. IFOS or business income assessee has the option, so he can exercise that. ATE, interest on loan taken for children education. What is given is articles and not books. Books-க்கு தான் 80QQ. No DTA exit in country X. All incomes are chargeable at 15%. Royalty is 13,60,000 plus house property is 243,600. 2,43,600 both into 15%. Okay, repeating, royalty plus house property income into 15%. Am I clear? Am I clear? I'll do the next question later. Later means in some other class. Okay. Today, after the break, let's go for assessment of companies because we have some substantial time. Well, let's not stick on to DTAA itself. We will go for assessment of companies. Okay. So let's take a half an hour break and come back for assessment of companies. I'll as of now switch off this video, my dear online friends. I'll send you the material and then take it. Okay. Meet you after the break. All the best.